Welcome to The Fine Print, the podcast where experts at Succession Resource Group unpack the latest industry trends, recommendations, and observations for independent advisors managing their practice with no fluff and hopefully a little entertainment. In each episode, we'll discuss ways in which you can understand and leverage the value of your business, grow your business through M&A, but also through an optimized organizational structure. Improve and protect your business to create a sustainable enterprise that can hopefully outlast you. And lastly, preparing for your eventual retirement and how to maximize that result. We're not just tackling high-level concepts, hence the title. We're getting into the details, or the fine print. So, we encourage you to listen in with whatever beverage suits your preference, and let's get to the forefront of industry trends with a fresh perspective to help you achieve your long-term business goals. Welcome back to another episode with your host today, David Grau. Today, I want to talk about a topic that I feel like we've been talking about sort of ad nauseum as of late. It comes up at industry conferences. It comes up on conference calls, Teams meetings, Zoom meetings. It doesn't matter if we're talking with large independent RIAs. It doesn't matter if we're talking to sort of small, boutique-y, great lifestyle practice under an independent broker-dealer. And that is the topic, I guess of value, but more specifically, private equity and its impact on value, perceived value in the industry. So anyway, something I'm really excited to talk about today since I get to control the mic. And this is a subject that we talk about a lot. And I don't think it's going away anytime soon. So it's certainly worth addressing because it's, I don't want to say having a profound impact, but whatever's right below that, it's having that level of impact in our industry on advisors today. So a little bit of background for those of you who haven't, stayed current on valuations across the industry, or just even, I'd say the general evolution of mergers and acquisitions in the financial services space, because it's still kind of new. M&A in our industry, the independent financial service professionals, we've legitimately only really been actively buying and selling these businesses for, I don't know, I'll be conservative and round up here, maybe 2 decades, 20 years, which, sounds like a lot, but for a lot of you listening, frankly, you've been in the industry longer than that. And when I say the last 20 years, it's probably been, I don't know, maybe the last 10 years, where you've really seen advisory firms, big and small, being bought and sold regularly, where you've got owners, I won't say starting with the end in mind, but certainly expecting to get value for their firm. That was not the norm 20 years ago. I would tell you when I started out doing this in 2004, 2005 timeframe, you'd spend half of the first couple of phone calls just trying to convince advisors that there was value in their practice and value that they could monetize, that somebody could take that business over and continue it at their exit. They were legitimately not convinced that was even a possibility. And I get it. It's such a relationship-based business. Oh, how far we have come since the early 2000s. So when you think about where we're at historically versus where we have arrived at today, there's been a ton of industry consolidation in the last 10 years. Industry is not getting any younger. There's some firms out there doing some cool stuff around recruiting, bringing in young talent, but not at the pace that we're seeing folks exiting, or at least those that are heading towards an exit. And honestly, there's a fair amount of consolidation that we've seen that's probably healthy. Owners who, admittedly, they had no business owning and running a business. That is not why they went independent. They just wanted more freedom to serve their clients, and the path of least resistance to do that was to leave the wirehouse or bank or trust company, wherever they started out, and go be an independent advisor, go start their own independent RIA, wherever they landed. That was their goal. Their goal was not to go be a business owner and pick phone systems and pick their technology stack and manage staff. And they just could not wait to go independent to set up payroll and figure out employee benefits. So I think for those folks, it is great because they went independent that they've been able to have this sort of monetization event of their business they've spent so much darn time building. But But I think that level of consolidation, it makes sense. It's healthy. But there's been some additional consolidation here as of late that has gone well beyond that. So, if you look at the clients that I served and worked with, 20 years ago, 10 years ago, as opposed to today, we've seen a major shift from sort of that solo producer who's out there building his or her book of business, doing great work for their clients, sort of shifting over the last, I don't know, 10, 15 years to these siloed teams where it's kind of a bunch of solos, but all working together under one roof, like physically for a very long time. They'd move in together. They didn't merge, but they used a shared brand name, shared front desk person. Shoot, they might even share a copier. So they shifted from solo producers to these siloed teams, now to seeing truly integrated teams. They're really kind of growing into what I'd hesitate to call an enterprise. Or, some of these firms are legitimately enterprises. They'll have a staff of 40, 50 or more. They have systems, they have processes. Their teams are now specialized where they don't just have advisors. They have kind of quasi-hunters and farmers. People are really good at business development, closing the business, sourcing it. And they've got an amazing support cast that is great at making sure the clients aren't leaving out the back door as fast as we're bringing them in the front door. So that's been the interesting evolution, and M&A has sort of grown up at that same pace. In the past, when you looked at your exit strategies, you didn't have a ton of choices. In the early 2000s, you saw some industry aggregators, starting to have some success, but it wasn't the norm. So historically, the aggregators, they had to bring really strong offers, to be seriously considered, because it was kind of viewed, it seemed like, as selling out. At least from the sellers that I would work with, 15, 20 years ago, that was the opposite of what most of these advisors wanted. Again, they went independent to have freedom and flexibility and choice. So the idea of then leaving a big wirehouse or bank and eventually 20 years later, selling back into sort of one of those kind of equivalents, it just rubbed them the wrong way. What most sellers wanted then, even now to some degree, they just want someone who's just like themselves, just 20 years younger. Most buyers in the past would put, 10, 20% cash down, because that's all they could pull together. And then the seller would finance the balance over 3 to 5 years. Sellers were never super excited about that prospect, right? You're giving the buyer the money after getting 10 or 20% cash up front. You're giving them your renewals, your fees, your trails, your 12B1s, only to have them give them back to you over the next 3 to 5 years. So you had a lot of folks who understood the importance of succession planning academically, but practically the dollars and cents just didn't line up. They would just stay and sort of retire through attrition. But if they were contemplating a deal like that, the aggregators would win the day sometimes because they had more cash. They had access to capital. Buyers did not, or at least the Main Street advisors did not have access to capital. So the aggregators would come in, they would write bigger checks, they could put more cash down. And again, they had to sort of win the day and get the seller's attention. And long term, they would win on efficiency, scale, reducing cost, help drive more growth. They could make the math work for themselves, for sure. They had the ability to reduce costs, and they really could help drive growth, especially for a lot of these smaller practices, smaller RIAs. And the larger down payments meant they would win the deal. Unfortunately, that competitive advantage for the aggregators, I'm not even to the PE stuff yet, that was sort of eroded, and it was probably late 2013, early 2014, when you started to have some lenders like PPC Loan and Live Oak Bank, at that point, commit some meaningful capital to the industry. Now, granted, PPC had already been in the space, I think, back in like 2006, 2007, but they came back in a big way and really committed some resources and time and effort and a great team in 2013, 14, and same thing with Live Oak. So now all of a sudden, everyone can show up to the party offering 100% cash down if they so chose. As long as you weren't crazy with the deal and multiple you were offering. Now, on the topic of multiples, then, the last 2 decades, multiples have gradually increased from, I think it was like a low of 2 times on recurring back in the early 2000s up to where we are today now with an average of just north of 3. 3.08, I think, was our most recent average top line recurring revenue multiple. Or now we're right about like 9.2 on EBITDA. So, said another way, if you compare and contrast historically the deals to the values, people used to pay around 2 times the recurring revenue, and they would pay that back in 3 to 5 years with a small down payment, to where we are today, where the average is 3. So it's gone up, obviously, but they now have a decade to pay the bank back. So the cash flow on these deals, for the most part, is pretty strong. So how do the aggregators then come in? How do the PE firms come in, or the PE-backed aggregators come in and start offering 4 times top line revenue, or in the teens on the earnings multiples? Well, they're very good at what they do. They create deals that they're so creative, frankly, in some cases. Many very competent financial professionals sort of get maybe dazzled by the numbers is the best term for it, because they're strong numbers, they're strong offers. Unfortunately, sort of sometimes, not all of you, probably none of you listening, because you're too focused on the subject matter. But a lot of folks are getting these letters and they are dazzled by the numbers. They sound really good. And unfortunately, I feel like they sort of get distracted sometimes from the reality that is cash flow and ultimately what's best for their clients. And that has been a really cool thing to have seen working in this industry for the last 2 decades. And frankly, why I think a lot of the industry lenders committed the capital they did is because the default rates are so darn low. Well, the default rates aren't just low because of the recurring revenue. That helps. It doesn't hurt. But the default rates are so low because historically, it felt like just about every advisor I've ever worked with, or that our team now works with, they're focused on the fit. That is their top priority, is the fit between the buyer successor they're picking and their client. Price and terms, definitely in the top 5, always has been, always will be, but fit was always number 1. That is slowly changing. And by slowly, I mean like as of late, it's like number 2 or 3 somewhere on that list. And it's now price and terms, which I don't love to see. And I think it's going to be reflected in many cases in the future with additional deals happening where you start seeing some of these things not go as well as hoped, even though the exiting seller got a really big check. So, while these firms are offering above market multiples, undeniably, what you see in the letters, if you've gotten one, those are real. Unfortunately, it's no different than the deal making that we do here or that anybody else does. We're all working with the same pile of money. When it comes time to sell your practice, we can't magically make more of it. It does come down to the terms. So while they're offering above market multiples, that's real. It's like most deal making. You pick the price, I can pick the terms. I can find a way to make whatever multiple you pick work. If you pick the terms, I can probably give you a multiple that supports it. Well, what they're doing is offering really strong multiples and then really creative terms to make those multiples justifiable. Because again, especially when you talk these PE-backed aggregators or direct private equity investments, these are really good firms. Like, this is not their first rodeo. They've done deals before. And frankly, especially when you look at the PE-backed aggregators, basically these aggregators have done it enough times now that they have somebody else's money to go gamble with. They're good at it. They win or they go home. So it ends up showing up in the deal terms. So we're seeing a ton of PE investment firms, a lot of PE-backed aggregators getting super active in the market. I mean, I wouldn't say that they're necessarily winning the vast majority of the deals, but they're certainly getting a lot of time, a lot of attention, and they're getting some, sizable deals done. But at the same time, for every one of those that are done, there's 20 or 30 others that you'll never see or hear about. Peer-to-peer deal, a couple $100 million in AUM, and they sold to son or daughter, key team members, existing partners. Those just don't make the news. So was at a conference here recently, and I heard somebody talking about the fact that, I don't remember what quarter it was, but they were talking about 100% of the deals were done with private equity-backed firms or PE directly, which, again, from the seat they sit in and the data they have access to, probably a true statement. But legitimately, for every one of those you see, hear about, or know about, there's at least 20 others happening. But it's getting so much time and attention, we got to talk about it, right? So what's all the hype about? I mean, price, bottom line, like that is what's driving the time and attention, and it's why they're leading with it. I get it. I mean, for all of us as business owners, you want to get as much value for your practice as you can when you exit. You work very hard to build the business. You don't want to give it away for a song. The funny thing is, historically in this industry, that was legitimately what we heard from a lot of advisors. They weren't super focused on getting every nickel out of this thing. They wanted their team to take it over. They wanted their team to be successful with it. They wanted to sell it to their peer, their colleague. They wanted a fair value, but they weren't worried about squeezing every nickel out of it. Now, all of a sudden, I don't know if it's because of who the buyer is, and it's just maybe a little bit less of a personal connection. It really does seem to be about dollars and cents and getting that last nickel out of this thing, getting the most value I can, even at the expense of my clients. Not always. Again, there's definitely some deals here with the private equity firms, aggregators, where they bring a ton of value. But I can tell you, a lot of the firms we're talking to, that is not their modus operandi. They're trying to, as an owner or founder, get the most value for their business. And while I think that is a healthy mindset, it's got to also be combined with making sure we do right by the clients. And especially with so many RIAs acting as fiduciaries, I mean, this is the last thing you do, if it's for exit planning purposes, this is the last thing you'll do for your clients. So what's all the hype about? It is ultimately about price. So owners who historically focused on fit are now kind of doing a 180. It makes me a little sad for the industry because I think that was one of the really cool things that you could hang your hat on in this industry was, unlike so many other professional service firms, this is a relationship-based business, and advisors honor that relationship even at their exit, sometimes leaving hundreds of thousands of dollars on the table, passing on the highest offer because the second or third best offer was with the right firm for their clients and their team long term. I'm not seeing as much of that. I'm still seeing it for sure. And I hope, frankly, most of you listening would say, yeah, when my time comes and I'm ready to slow down, cut back, and sell this thing, I will focus on fit. I want a fair value, not giving it away, but I'm not selling out. But the amount of conversations I'm having make me question that sometimes. So how do the deals work? How are they making these numbers work? Well, I will say in general, these PE firms, like I mentioned, or PE-backed aggregators, or even just general aggregators, even if they haven't taken private equity, they are really good at what they do. I mean, we work with these firms. They have systems, they have processes, both for doing deals and sourcing deals. They have built scale. They are great at marketing. If you have one of their letters or you've gotten an email, you know what I'm talking about. If you haven't gotten one, trust me, you probably will. They are better at deal making than you are, period. I don't care if you're sitting here listening and saying, well, I mean, I know what David's talking about, my peers, but I've done 10 deals. I've done 25 deals. I've done 50 deals. They are better at deal making than you are. I don't say they're smarter, but like they have people on their teams that this is all that they do. And they do a lot of deals and they do deals their way. So I feel like it's that old poker adage, if you're at the table and you don't know who the sucker is, it's probably you. Well, even when you're confident it's not you, at this table, it's probably you. So just go into it with eyes wide open. We've definitely seen some folks and we've had a chance to talk and consult and work with these firms. And for a lot of advisors, they go in with eyes wide open. Yes, they're dazzled by the numbers initially, but they're also cautiously optimistic, a little skeptical, which is good. So how do these deals actually work? I mean, again, I'm going to say no two deals are created equal. But also, having seen enough of these deals, I mean, a fair amount of them do look kind of similar. Because remember, we all have the same economics, more or less. So normally when you sell the business, either sort of off market to a peer, colleague, a friend, or you let a firm like ours list the practice, work with those colleagues and friends, but also bring some other candidates to the table to make sure you really sort of turn over every rock and then work to negotiate, get the best price and terms you can from whoever that individual is. You can sell the business and retire in 6 to 12 months after the transition's complete. You can sell the business and stay. That happens a ton. Selling and retiring happens a ton. Can you transition an entire book of business you built over 20 or 30 years in 6 to 12 months? Yes, in fact, you can, and retention rates are surprisingly high, like north of 90%. Is it better, if your firm is big enough to be able to sell and stick around for a year or two, maybe 3 or 4? Yeah, it's more complicated for sure. But to the clients, when you do that, it looks more like a merger than it does a sale. So that was the historic norm. You would get 70 to 80% cash upfront at closing. At least if you listed with us, for example, it'd be 70 to 80% at closing and the balance within 12 months. If you worked with a peer or colleague, sort of an off-market deal that we help facilitate, those will usually have, smaller down payments, a little bit lower multiples, lower valuation, but you're selling to a colleague. Like, you're not selling it to get the most value out of the business. So it's understandable. But that was normal. You had most of your money within 12 months. And the values historically, and even now, are between 2 and probably 3.5 times, expecting all of your money in the first 12 months. For the buyers, having run the cash flow analysis enough times, or at least me historically, now my team, most buyers in that model, depending on the deal and the size of the seller's practice, their compensation, if they're going to sell and stick around, most buyers are taking home probably 10 to 20% after expenses, taxes, and debt service. Like, that's a pretty safe benchmark. Like, no one's retiring early on it, but it's accretive, it's cash flow positive, and it only gets better then, obviously, as that practice grows, which it usually does. And as we get, obviously, the debt paid down, we have less cash outflow, and we can work on growing the business. So that's normal. The aggregators, that is not the deal that they offer. They might be offering 3.5, sometimes 4 times revenue. Like, you're right, 4 times top line revenue is a deal and an offer I have seen more than once. Or in the teens, 12, 13 times on EBITDA. For practices that really have no business getting 12 or 13 times EBITDA. When you look at deals taking place out there without weird, quirky terms to support it, businesses do get 12, 13, 14 times earnings, but they are amazing practices. I'll watch my language, but they're really, really good practices. I think you know what I mean. They justify those multiples. However, we're seeing these PE firms, we're seeing private equity-backed aggregators, and aggregators making these offers to firms that are not really valued at 4 times revenue or 10 to 14 times earnings. They're just not. They're not that good a business. They're good businesses, mind you, but they're not that good. So how do they justify it? Well, they do it through the terms. Most of these, if you've gone through the process far enough and you get the terms conversation going, you'll find it's usually around a third cash at closing, non-contingent, non-refundable, like legit money in your bank account. You can expect about another third paid in aggregator or private equity stock, equity in their firm. Not the worst thing in the world, but you're taking a flyer and counting on their equity growing faster than yours, which you have very little control over, and they've got some pretty aggressive projections. And then the last 1/3 is usually performance-based, i.e. if you hit your growth benchmarks, then you'll get that final 1/3 installment, which is effectively you ramping up your growth to hit these growth targets because they're not super conservative and effectively paying for your additional value. Like, you got to do the work. You can't sell it and then retire. You got to be here to generate the growth to get that last 1/3. The other problem I run into is when you start looking at the math on these, let's say you're okay with that deal, the 1/3, 1/3, 1/3 I just talked about. Well, the problem is the 1/3 that you're getting in aggregator equity or private equity stock, if you look at the multiples that they're using on their valuation, you thought your multiple was aggressive. Just look at theirs. Now, granted, they'll show you some pretty amazing decks and growth targets and that they've hit them so far. But that kind of growth that they'll show you to justify those kinds of multiples, are hard to sustain as you get bigger. These ain't tech companies. So very aggressive multiples on their side, which means if they're, I'll hesitate to say maybe slightly overvaluing or being optimistic on the value of the stock they're giving you, and it's a third of your total value, you've effectively got 2/3 of your purchase price contingent. Now, again, what you'll start seeing, I've seen this a lot lately, they'll show up and they'll pay all cash to buy a small stake, maybe 15 or 20% in your firm at a high multiple. And you think, well, shoot, all right. And they'll guarantee you we'll pay the same multiple on the back end. Again, the question is how and what do you have to do to get it? Well, that you oftentimes won't find out until you're already sort of pot committed. So just, again, go into it with eyes wide open. These aren't things to deter you, but what really sucks is when you are talking about doing a deal with a peer or your internal team at, current market multiples for your firm, you get a letter in the mail that sort of distracts you. It's worth at least kicking the tires on. And you end up pursuing it only to find out, okay, well, we're not comparing apples to apples here. I want to help make sure for any of you listening, when the time comes and you're talking with maybe one of these firms and kicking the tires on it, you're comparing it to your other options, get somebody who has experience doing this to help you through that process. Selfishly, we'd love, obviously, to work with you at Succession Resource Group, but just more generically, get somebody who's in the trenches, who does this, who can help be objective, if nothing else. Because again, these firms are really good at what they do, and this isn't what you do. You're a really good business owner, really good advisor, and a good steward to your clients. So where does it make sense? There are definitely deals, there's scenarios where I've seen where advisors are actually really happy having gone down this path. I would say number one, larger firms, not huge firms, but larger RIAs, they've sort of outgrown their internal team's ability to buy. Now, again, that's sort of self-inflicted because if they had started with the end in mind and built their team with the expectation and intent of transitioning it internally, they'd have 2 or 3 Gen 2 advisors for every Gen 1 founder who might be exiting, and build that pyramid and that strong base and that farm team of talent. But it happens. Firms get big, they grow inorganically, they grow organically, you've got appreciation of the market assets. It doesn't matter how they got there. They got there. Their firm is too big for their internal team to either financially afford or emotionally be willing to commit to, because you're talking millions of dollars in some cases. That can be a really good stopgap where the PE firm or the aggregator comes in, they buy a minority stake, and they allow the founder to take some chips off the table, and they give some relief to that next gen team where if the valuation's 20 or 30 million, for example, which would be pretty conservative for these size firms, PE firms be talking to, if they can come in and take $1 million of that problem off the table for everybody, well, the next gen could maybe take down the balance. That seems more doable. So really good fit there, it seems, from what I have heard and deals we've seen. Also, firms that are looking for, rapid growth and expansion. I get it. If you're running out of capital, trying to do it kind of, I don't want to say the right way, but sort of the normal way where you're going to go borrow the money, this can be a really good way to put some jet fuel on the fire and get resources that you need. Bottom line, it might cost you a little bit in the short term, but if it can support your rapid growth and expansion goals, that can be justifiable. Where is PE or aggregators or PE-backed aggregators not a good fit? Smaller firms. That's all relative, and they're certainly moving down market. Plus, you've got some of these aggregators, for example, that have different locations, beachheads in different cities now, where, they may only look at firms with a couple $1 billion in AUM if they're going to establish a new territory. But if you're right next door to an existing office they have, well, you know what? If you've got $1 billion, they might still be interested. But that becomes very location specific. So I'd say in general, smaller firms, if you're still sub $1 billion, although I feel like $1 billion nowadays is almost still a little too small for most of these firms to seriously consider establishing a new location, a new hub. So it's usually going to be a couple billion, or at least a couple billion to get the multiples that most folks are talking about. So smaller firms, not a good fit, or as your exit solution. Like, they're not trying to buy and take over your business and have a job. Remember, these are investors. They're trying to buy a turnkey operation. So they're not a good solution for your exit plan unless you already have a pre-built team that, again, just can't or doesn't want to take it over. That can work. But it also, you combine the smaller firm and the exit planning. There's a lot of folks I know that, because I've talked to them at conferences recently, where they've gotten these letters in the mail. They were already contemplating selling their firm now or next year. And now they're thinking, well, I'll just sell it to the aggregator, the PE firm, because, I mean, these multiples are much higher than what we're reading out there from the various industry pundits like SRG. Well, yeah, but they're not going to write you that size check, especially as your firm is currently operated. They don't want to buy jobs. They want to buy turnkey operations. There's a lot of firms growing up into true teams, true enterprises, but there's a lot of really amazing lifestyle practices that have no business talking about or negotiating with private equity or even the aggregators. Also, those looking to sort of deleverage or just slow down and cut back, not a good fit. You will not like the results. But there are definitely instances where I have seen folks do deals with aggregators, private equity-backed aggregators, and PE directly that hit it out of the park, and they're very happy. Again, I do question, and I was just at a panel discussion conference meeting at Live Oak Bank headquarters, talking about this very subject with some amazing people from Fidelity and Schwab on a panel, Nicolai and Laura, and they had a great discussion on private equity and their perspective on the long-term game plan for a lot of these PE firms making investments. Because remember, we're all familiar with private equity, and we've all heard the horror stories, and it's not all bad by any means, or nobody would do these deals and they wouldn't be around. There are definitely wins to be had. But these also are not buy and hold long-term investors. They want a large return, and they want it fast, and then they want out. So just factor it into your game planning if that's right for you, your team, and your practice. So takeaways, honestly, just focus on the fit with your clients. If your rapid expansion plans sort of necessitate taking PE, then great. It aligns with your business plan. It doesn't compromise sort of your fundamentals. Maintain the focus on building the internal succession plan, and ultimately your business will be more valuable. It will be more attractive to anybody. It'll be more attractive to your peers because it's a turnkey business. It will certainly be more attractive to these outside investors because it's turnkey. And who knows, maybe it works out and you just get to sell internally or some combination. But I would keep internal succession planning as plan A because it helps drive everything else. If you really do want to sell out and just get the biggest check, well, building your internal succession plan, or at least your internal team that could be your succession plan, is the path of least resistance to get there because it will force you to train and mentor and build systems and processes. Those things all drive value. So do profits, so does recurring revenue, I get it. But the team is sort of the lifeblood of these businesses being able to grow and scale. A couple other takeaways, and then we'll wrap things up. Don't rely on somebody else to help you get the value you want. I mean, it can work, but in most cases, it feels like a shortcut. And I feel like every darn time I take shortcuts, whoever I'm trying to take the shortcut to beat always ends up beating me there. And in fact, I usually regret it. So in a lot of cases, this feels like some advisors, some amazing teams trying to take a shortcut to get to a higher value. Build a business the right way. And if partnering with PE or PE-backed aggregator makes strategic sense, more power to you. But go into these deals with eyes wide open. And honestly, I don't care who you work with. I mean, selfishly, again, I told you we'd love to work with you, but just don't go it alone. And don't rely on tax or legal counsel for business advice. And that's what most of this is. It will get down to contracts and tax strategies. But that's down at like the 10th, 11th inning, or maybe details in an offer letter. What you need is somebody that can help as an M&A consultant or an M&A expert, an investment banker. I would tell you the vast majority of these deals do not necessitate an investment banker. They definitely have their place for sure. Then there are some situations that necessitate that. But usually what most of you need listening is a good merger and acquisition expert, a consultant. don't go it alone. Build your team. And if you can, it's great to build those relationships before the opportunity presents itself so that you know who to call. You got somebody on speed dial. Anyway, lots more, frankly, that we could unpack on this topic. And likely we're going to touch on this on other future episodes. Because again, I don't think private equity is going anywhere. I think it solves a problem in many cases. And it's an interesting subject matter. It can help unlock value. It is undoubtedly driving value in the industry. And that's, I guess, good for everybody at the end of the day. So hopefully this is enough to at least get your gears turning on the subject matter. If you're contemplating having conversations with, one of these private equity firms or an aggregator, again, at the end of the day, all we really want to do here, all I want to do through this podcast is, if nothing else, sort of be your catalytic consultant, just get you thinking, create some unrest so that hopefully you can go in, remain optimistic, but a little skeptical. And that healthy dose of both, I think, will ultimately end up getting you probably the best results, no matter who you sell to. So with that, we'll wrap it up there. Again, there's a lot more we can and will say around the topic of aggregators and private equity, but I think if you just keep reading the trade publications, you and I are both going to see it. This topic's not going anywhere, at least not for the foreseeable future. Thanks, folks. Be well. And that concludes another episode of The Fine Print from SRG. We hope you found this episode both interesting and valuable. We encourage you to check out our website at www.successionresource.com. And of course, connect with us on social media for the latest happenings here at SRG. If you just can't get enough of The Fine Print, we invite you to join our monthly webinar series and newsletters where we address many of the topics covered in this podcast in greater detail. Finally, if you enjoyed today's episode as much as we did recording it, please leave us a review, a good one, mind you, and tell your industry friends about us. Your support helps us continue to bring you the best content possible. The information covered and posted represents the views and opinions of the guests or individual hosts, and not necessarily the views or opinions of Succession Resource Group. Content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional advice, as amazing it might be. Always seek the advice of an expert with any questions you may have. As always, we at SRG stand ready to help when you're ready.